Hello, everybody. Welcome to another episode of Arthur's Roundtable. Super grateful for everybody that's paid attention to what we're doing here. It's been a lot of fun, and we appreciate the Family Office Insights community sharing it with others and listening in when it makes sense for you. And if you continue to do that, we super appreciate it. We're grateful to have Ryan Duff, who's a real estate investor and also has a fund that we're going to talk about. And we're going to start with his origin story here, which is always interesting. And in this case, also very interesting. And so I hope you enjoy it. And I look forward to, and by the way, Ryan will be presenting on Family Office Insights platform in the coming weeks. So stay tuned for that as well. So Ryan, thanks for doing this. Super happy to have you. You're in Boston, right?
Yeah, thanks, Arthur. Appreciate it. In Boston, yes. Born and raised here, left for a little while, went to school in upstate New York, moved to Manhattan, and then came back about 6 years ago. And we're currently in the city still with my two little ones. Haven't bit the suburb bullet yet, but I think it's in the not too distant future.
It's coming, huh? Yeah.
Yeah.
It's tough
Walls are
with
closing
kids.
in.
Yeah. So tell us how this all began. That you're able to be in a position to deploy capital in a meaningful way in the multifamily space. Um, it's a there's cycles, right? So, but tell us how all this started.
Sure. So I've been in the business about 16 years now. I started at a company called Arbor Realty Trust on the debt lending side. Think agencies, Fannie Mae, Freddie Mac, FHFA. We lent balance sheet products across all different types, shapes, sizes, markets of multifamily assets. And I wove my way through the analytical underwriting side, from screening deals over to the production realm, which is where I started building a book of business for the better part of about 12, 13 years. I started representing owner operators, developers, brokers, folks that were mom and pop operators, all the way up to the institutional type developer. And I was structuring debt products for them. Acquisitions, recaps, refinancings, construction loans, bridge loans, preferred equity, mezz. And so it was at that time I really got a good feel for how to invest and how to invest the right way with the right people and what markets I wanted to be in. And so I started doing just that. Probably about 13 or 14 years ago now was when I first dipped my toes in as an LP in the multifamily space. Took piece by piece of my commission checks and started building a portfolio of exposure and investments. Nice. And fast forward, 10 years after that, I was sitting on a couple thousand units and had the freedoms of passive cash flow and a couple cycles within that time frame as well. And it was about 2023 when I looked in the rearview mirror. Obviously, when rates started to run up and catch everybody off guard a couple years prior to that, I found myself wedged in between the house, my employer, and my client book, trying to mitigate losses, loss sharing, avoid foreclosure and workout events, and realized it was a colossal waste of my time. And so I spoke to
It's
Brass.
often more work than underwriting a new deal, right?
Entirely. It's exhausting. It's emotional,
Yeah.
and you don't get anything from it. And so outside of just, maintaining an existing relationship that you've already cultivated and nurtured and executed for. But it was at that time where I really started thinking to myself, given the time of the cycle that we were in, and wanted to feel and build something where I could leverage the sourcing and the deal flow capabilities that I had and my access. And that access being the network of GP operators and developers that I had built over the decade plus prior to. And so I came up with the idea prior to even leaving my former employer. I've been gone now for 2 years, to build out kind of a conduit platform that ran a series of micro fund strategies targeting all different types of capital, from the retail LP investor all the way up to the institution, think family office in the middle, think RIAs, allocators, fund of funds, etc., and give them an opportunity and visibility into the predictable pipeline of deal flow that I had access to. I handpicked a half a dozen GP operators that I knew well, many of whom for 5 or 10 plus years we had relationships dating back to. I would say most, if not all, I had personally invested my own capital with. And I started to build a platform around them, knowing that I had a bit of a moat of deal flow given their visibility in their respective markets. And I started to introduce that to my network. And fast forward, I left Arbor in 2024, and I scrubbed my network, created a database of about 100 or so people, 125 contacts, mostly friends and family, former clients, people that I had been organically introduced to over time. And I put together a fund. My first fund was, I think, about $6.5 million. And we subsequently deployed that within the first 6 months into a portfolio of multifamily deals, all off market. I believe there were 6 assets in that portfolio. And the bell rang. And I realized that I could kind of, consistently, repeatedly put this process in motion with new and repeat investors and deploy their capital in a condensed time period into off-market deal flow that nobody really knows exists because of the network that I created. And so fast forward to today, this is our towards the end of our second full calendar year since inception. We're up to about 90 investors. We're currently actively raising for our 4th fund. The first 2 funds, are fully deployed. The 3rd fund's about 65 or 70% deployed. Last year, we invested in 10 separate assets of about 1,700 doors with a total capitalization around $300 million. Our strategy is a bit unique. I wouldn't say it is consistent peer-to-peer or some of the comps in our marketplace. Clearly, our differentiator is our deal flow, right? We are actively building out our bench of GPs that constantly supply us deal flow, which precedes our equity raising by about 3 to 5 months. So we'll make deal commitments well in advance, and we will back into the equity, whether it's raising a new fund, whether it's putting together a single purpose vehicle for a particular deal, or drawing down the existing undrawn funds that we have from prior vehicles. So it's become a bit of a repeat cyclical aspect to the business that we're creating. And listen, I think as it relates to this year, we're in growth mode. We're in scale. We know we have the allocation assigned to our business to grow probably 3 to 4 times over this year. And the source of that capital is going to come from larger check writers, single source capital writers that can, stroke a 7+ figure check. To date, as I mentioned, 85 investors, pretty much all retail. We have a couple RIAs in there that have dipped their toes in with us, but for the most part, it's been $100,000 to $500,000 commits. I'm the largest investor in every fund so far, so there's significant alignment across the board with us as managers of capital, but also investors into the same deals that we're asking our capital to invest in. And so going forward, we feel that there's a huge opportunity in the space right now, given the visibility we have to deal flow, to deploy into distressed situations that have been created and by mismanagement, undercapitalized owner operators, capital markets, distressed lenders and balance sheets. And, we're at the forefront of all that from a deal flow perspective. And so, we feel that there's probably a 12 to 24 month window here where rates are going to settle in a little bit. Cap rates might compress. Occupancy rates will normalize. The influx of new supply that we've seen over the last couple years will steady out. They'll balance out. Concessions will burn off, which has been compressing rents for BC assets, which is where we participate. And once that happens, the demand will start to accelerate again, and rent growth will move forward. And we've been active in that space, and will continue to be. And the ones that have been active and not on the sidelines are going to be victorious over the next 3 to 5 years.
So when you talk about your GP relationships and the sourcing of deal flow that's off market, is it largely because they see things before they become publicly distressed and they can swoop in and say, okay, uh, we have certainty of close? Is it something like that?
Absolutely. Yeah. Yeah. So, right now we've invested with probably 8 different GP operators. These guys are vertically integrated. 90% of them are local to the markets where they have concentration, portfolios, economies, efficiencies, and a pulse to the marketplace and transaction volume. And so, when you're actively owning and operating within your target areas, people know about you, you have a reputation, and generally speaking, those reputations are clean. And to your point, they have execution power, right? And so when a deal comes up, generally it's off market or a pocket list from a broker, or it's a lender or a bank that's looking for a new buyer because the existing ownership foreclosed or worked out or
Or
ran out of
about to,
capital
right?
or about to,
Yeah.
right? And so, the distress comes in different forms. And what we've done is we have regionally positioned ourselves across the country to have operators in different markets that bring us deal flow of similar profile and caliber, right? We generally invest in 150 to 250 unit assets. We generally invest in vintages from 1990 to say 2010. There are outliers, right? We've done brand new construction deals that had a fractured lease up strategy, which in my opinion, you're acquiring a core plus deal that's brand new, but it is distressed because it hasn't been leased up appropriately. We've also done on the other side of 50 to 60 unit assets that we've acquired from mom and pop operators with massive pricing advantages and arbitrage because they haven't been marking rents to market because they've had tenants in place for 15 to 20 years and they don't operate efficiently. So our goal is to come in fractured situations and provide scaled equity, which in return commands and leverages profit share. So what I mean by that is we are passive investors. We oftentimes don't require control. We don't need certain rights and remedies that a JV or a larger fund might require to invest. Since we invest with the right folks that we have confidence and a reputation with, we
Yeah.
understand how they execute. And so we become frictionless in that capacity, whereby we offer the equity, oftentimes $1 to $5 million a deal. And in return for that, we command a profit share structure with the GP. So we're LPs. However, we are co-GPs economically. And to the extent there are situations where we put up our balance sheet, we're the key principal signing on the loan docs. I oftentimes am involved in the debt placement, just given my background and my expertise. It's a huge value add to the operator for me to bring debt advisory and placement and equity to the deal. You can't get much more aligned than that as far as being up and down the capital stack and having full visibility. And so the value create for us is really on both sides. Investors have confidence investing with us because they know our touch points up and down that stack and the relationships that we have with these operators. And on the GP operator side, they understand how we invest and what type of investor we want to be, which is really to stay out of your way because we know you can execute and get us to our return profile within a 3 to 5 year period.
So I know that's probably not the same across the board, but when you say GP in real estate parlance, it often means sponsor, right?
Yeah, GP is the owner, the operator, um, the general partnership. Correct.
Yeah. And so give us an example of if a GP brings in an LP that's not you, they're going to have their standard fee structure, promote, et cetera. And they're passive investors as well, most likely, right? Or especially if it's a smaller investor.
Yeah. So
In the case where, what I was getting at is what's the delta between that normal LP that GP would have and what you have aside from the help you can do, you can contribute with the debt and so forth. Are you adding, you know, 10% off the promote that the normal LP would get? Is it that sort of advantage?
Yeah, so it's circumstantial. We negotiate case by case, right? So for instance, if we're investing 10 or 15% of the equity, I don't really have a lot of leverage to go in and say, hey, Mr. GP, I want 50% of your upside, right? On
Yeah.
the flip side of that, if we are 40 to 60% of the equity, that's a different story. And so there's really no pricing metrics, if you will. However, it becomes a negotiation. I have conversations all the time with LPs about investing directly in the deal themselves versus coming with us, right? What's the advantage to coming through Seaport into these deals? Your economics on an LP directly into the deal that might be $250,000, $500,000 check writer is likely a 6 to 8% annualized yield, maybe a net return IRR of say high teens. And then your multiple is generally around 2 in a 5 or so year period. Okay.
Yeah.
When we invest with the scale that we do, we offer the cash flow and the annualized yield. We promote everybody at an 8% pref coming into our funds day one, right? No exceptions. So you're benefiting on a preferred return basis by coming into our fund. You're benefiting from the terms that we negotiate at the deal level with the GP, and that comes in different forms. Okay, so for instance, all GPs take an acquisition fee. All GPs take a management fee, asset management fee. We'll come in and we'll structure a sidecar with the GP whereby, okay, we're now participating in your acquisition fee. We're not going to be charged 2% asset management fee. We're going to be charged 1.5%. And then for bringing 40% of the equity, I want 15% of your upside. And so I take that upside and I funnel it directly into the investors upon liquidity event, which is generally a sale in our case because we invest for a condensed time period. And so from an LP in my funds perspective, you benefit from those 3 different silos economically above and beyond what you would benefit from as an LP directly investing in the deal by yourself, right?
Yeah,
because
for $250,000, 500, even $1 million check,
and it
right?
leverages different return.
Yeah.
Yeah, I mean,
even if
most
you're
of the
writing
deals,
$1
so
million
I didn't
check.
touch on this, but yeah, correct, right? I mean, $1 million is on this very small end for our investment. I'd say generally we are 2 to 6 on average, depending on the deal size. And to give you some perspective on how that floats within the deal, the equity stack, our total capitalization on 90% of our deals is between 15 and 50 million. Okay. And so when you're leveraging that up to say 65, 70%, meaning you're getting debt financing for 65, 70%, that leaves a total equity raise on average of about 10 to 20 million bucks, give or take 15, 8 to say high teens. We're generally sitting 30 to 50% of that raise. And so we're not all of it, but we're enough of it as a single source to come in and throw our weight around. And that comes in different forms is my point, economically, whereby everybody benefits. I could simply take that GP to myself and run with it, and deliver a very respectable net, high teen net result to the investors. But there's no added benefit then by coming with me versus going directly in the deal other than access, right? And so, I try to build a moat around our value. And so that value is beating the market on our management fee, which is only 1%, and then economically incentivizing investors to come with us above and beyond the access that you get, right? Because when we put our offerings out to our investors, our entire network sees every deal that we invest into 60 days prior to it closing. They could just as easily pick up the phone and call the GP operator and say, hey, I want to invest with you, right? I need to make our offering valuable enough to that individual or source to come with us instead of going directly to them.
Yeah, so they're not
And
even tempted to do that. Yeah,
not even tempted. And so, listen, it's the predictability aspect of it. I think the other thing that we've built, which is a significant differentiator, is that each fund invests broadly with different operators in different markets, right? Because we deploy our commitments across portfolios of 4 to 6 different assets. And so, God forbid, one deal doesn't do that well or one deal
right.
underperforms. You're getting the benefit of blended economics across the board, across geographies. And obviously, the profiles of the deal are very consistent from a return standpoint that we invest in, just because that's the space that we know and we don't want to deviate. I don't want to invest in deals that are too small. I also don't want to invest in deals that are too big because competition with institutions becomes a problem.
Yeah.
And so we know our space, we know our role. We're sitting in the middle to upper middle market, and we're trying to scale up in that space to become invaluable to the GP operators, who, by the way, have their own syndication networks, right? Which
Right.
is, if we're 30 to 40% of 50% of the equity, the other 50% comes from their networks, right?
Yeah.
They are individuals, LPs, retail, high nets, maybe some fund to fund types of their own. But, I'd say generally speaking, we're in the top 1 to 3 scaled investors in every deal that we do.
So can we talk a little bit about a couple of years ago, the multifamily space was super hot. Everybody was deploying capital, and there was a bunch of fraud, and there was some people got smoked. What, is it fair to say there's a cycle, and is it fair to say that you're in some way immune to that or benefit from it?
I'll answer A and C.
Okay.
We're in a cycle in different forms. We're in a cycle from a supply demand imbalance. Okay. Obviously, when rates were 1 to 5% or 4%, 5, 6, 7 years ago, nobody could do wrong. You could put a floating rate loan in place at 3% and buy at a 4 cap, and everything would go right, and you
Yeah.
2.5x your capital. You could get a construction loan and get a shovel in the ground for 4.5%, and deliver a product within 24 months with no supply disruptions, and costs would remain stable throughout the whole process. That's been flipped. And so that dislocation has created immense opportunity for those that have access, right? I think to answer the third part of your question, um, that opportunity is born from those moments of distress because of inconsistent underwriting, aggressive assumptions. And so we're now in the part of the cycle where a lot of the severe distress has been flushed. Okay. You take a look at 2 and 3 years ago, balance sheets were at all time high. You had debt funds that were bloated, that couldn't raise liquidity fast enough to offset their deficiency. And so what happened over the last 24 months is, you had a lot of refinancings going on, recap events. You hear a lot about the rescue funds, the recap funds, lenders cutting A and B notes just to buy themselves some time and
Time. Yeah.
try to solve their balance sheet woes, right? The deals from those moments that worked, and they're now off in the balance sheet, and they're now refinanced into a fixed rate 5, 7, 10-year deal going forward. The deals that are left are the deals that nobody wants. And so the distress on the lending bank side still exists, and it's because if you foreclose, the LP and all the equity is wiped out. There's a loss share problem at the lender bank level where they're taking it on the
Yeah, you
chin
have to
too.
post it to your balance sheet that you've
Yep.
actually have a realized loss. Right?
Right. And so lenders are still hanging on a little bit to, I would say, 40% of that balance sheet that they had 4 years ago. Right. The other 40 to 50 to 60% was salvageable, and people took a haircut. People had to cash in capital calls on LPs, take a preferred equity note at 10, 13% just to get out of their senior. But a lot of those opportunities found buyers, found homes. And so we've taken advantage of a lot of that. to your market cycle point. So a lot of the distress came out of that moment. However, fast forward to today, supply's fallen off a cliff. Nobody's been able to build in the last 2 years, right? They've been delivering property between 23 and 25, which are now in lease up. However, these lease ups are going poorly because there's a ton of competition in the marketplace, and they're having to offer concessions, which does nothing but become bad debt and write-offs, or it falls to the bottom line and you're losing operating income. And so those situations are also opportunity. We acquired a deal in Charleston, South Carolina, which was an extremely unique situation. It was a 2023 delivery. It took him 3 years to build the property. He was sitting on a fully delivered asset. Mind you, this is 260 units. And it took him 12 months to get utility hookups from the MSA. And so he sat with a vacant property. He burned through his construction loan. He had to refinance at a high-cost bridge loan. And then he just jammed a bunch of heads in beds, I call it. Got his occupancy to a point where he could list the sale at a fraction of the original cost basis. So we came into that deal at a 30% discount on a brand new Core Plus institutionally grade asset. However, we inherited problems because he jammed a bunch of ill creditworthy tenants in the property. That said, that's an opportunity for a great operator to come in who's capitalized and knows how to complete a lease up or do a value add in nature. Although it's a brand new property, there was still a repositioning that took place. Day one, we got in, evicted 70 tenants. So occupancy went from 92 down to 83. It's now back up to 96. So the opportunities come in so many different shapes and sizes. However, you can't just enter the market today because you raised a bunch of capital and you see rates coming down in the next 12 to 24 months. You had to have been in the market the last 18, 24 months to get the access.
That totally makes sense.
And I think, God willing, we've positioned ourselves with the right guys that have the good reputations that I spoke about within their jurisdiction and their markets to get access to these deals. And these deals are coming in those different forms of distress that I mentioned. So the pipeline's predictable for those that have been in the right spot over the last year and a half.
Can you talk about location? You mentioned one. Is it largely dictated by where you have these GPs and confidence in their ability and have a property that fits the box? Or is there some geographic preference?
So I first launched this thing thinking that I was just going to sit my butt in the Southeast, in mid-Atlantic, just because those were the markets that I knew well, that I knew had a lot of distress because everybody entered those markets 6, 7, 8 years ago, and many of them lost their shirt. There was a lot of leverage in these markets, a lot of bank and lending exposure. I quickly realized that was foolish of me to even consider pigeonholing ourselves and the opportunity set that we now have access to. We are now nationwide. I am market agnostic. That said, we gravitate towards tax-friendly environments, both from the landlord and the tenant. We gravitate towards markets that have good migration trends, good demographics, good employment growth. We are suckers in the port towns of Charleston, South Carolina, Savannah, Georgia, because of, having the import-export, situations that they do. Markets thrive off that. And it's not just, the immediate employment, but, you have tier 2, 3, and 4 job opportunities for folks that feed that type of business. So yeah, we're now market agnostic. I mean, I think we're in 8 different markets. We are up and down the East Coast. I would say heavily concentrated in the North, South Carolina, Tennessee region. We are in Central Florida, Savannah, and now soon to be Conyers, Georgia, which is about an hour south east of Atlanta, which is a great re-entrance into that market because that's where everybody played and did well or not over the last 5 or 8 years. And we're getting a great opportunity there that's coming in from a liquidating REIT that unloaded 30 assets 15 of which were acquired by Starwood at about a 30% discount, and we just plucked off one of them. I love Indiana. I love Indiana, Ohio, Kentucky. There's new manufacturing going back into these markets. There's a lot of data center development, and there's good growth and steady jobs, steady incomes, right? We are, I say this, it's a little cheeky quote, but we're trying to preserve affordable housing stock, right?
Yeah.
And people that are
I don't
our
think it's
tenants
cheeky. Yeah.
that
Yeah.
I mean, it's a little bit of a tongue-in-cheek kind of, politicized quote, but it's real, right? And I don't mean affordable housing stock, tax credits and Section 8 vouchers and, HAP contracts. I mean middle America. I mean folks that are making between 60 and 120,000 a year that can afford 800 to 2,000 bucks a month in rent. And you know what? That's going up. I don't care what you say, right? People aren't buying homes anymore. My generation and generations beneath me can't afford it. They don't have the down payment. That's why you saw Trump come out the other day and try to put a cap on institutional ownership of single family homes because he was worried about the affordability aspect and the existing stock of that asset class. We are multifamily. We are scaled offerings to concentrate units to offer middle America and the tenant that needs to rent and prefers to rent, right? And so back to your point about where we want to be in good lifestyle states. We want to be where there's warm weather, where people are moving to. I love Nashville, Tennessee, not MSA, but we're heavily concentrated. We got a deal in Murfreesboro, Tennessee right now, which is Rutherford County, top 5 growing county in the country, drafting off Nashville's growth, right? So Asheville, North Carolina, we're delivering and leasing up a 319 unit new build there right now. That's best in class and doing extremely well, in spite of the hurricane that rolled through there, just a short time ago. Those are the types of areas that we like to go into because there's not a ton of competition. It's overlooked by the institution. Mom and pops can't participate, and we have a foothold. We have existing relationships in those areas, whether we're already invested in it at the fund level or me personally. We know that we've been successful, that we have access. There's regional reps, there's site staff, there's good leasing agents, there's good quality workforce in these areas. And these properties can perform, and they stay full. And we can get modest rent growth still in this environment. Now, you might have to manage through some ups and downs and down leasing cycles. Maybe, drop rents 5%, to maintain that 93, 96% occupancy, just for the time being. Maybe there's competition in the market, a new delivery, or maybe a plant down the street shut down, whatever the case may be, you can adjust very quickly. And that's why we invest with the right operators, because they have the foresight, a lot of which is AI right now, believe it or not, which is maybe another topic of conversation, but that's really entering the management of multifamily and the projectability of where rents need to be, how your competition's doing, and how to optimize your product within your comp set in the marketplace. So
yeah, the research has to be a lot easier to do now, right?
Oh my God, Arthur, I'll tell you, maybe another bar of commentary, but we're going to stay as lean as we possibly can for as long as we can, right? And what I mean by that, acquisition teams are becoming obsolete, underwriters obsolete. I can throw a T12 and a rent roll and a pro forma or an offering memorandum into a AI tool. There's numerous of them. Give them some guidance. Within 2 to 5 minutes, it can underwrite the deal for me. It can project revenues insane for me in 3 to 5 years. It's insane. And it can perform a model. And
you still need the sniff test, right? But it's more likely than not to be accurate.
You need a human element, but that human element is no longer a team of 6, right?
Right.
And so we draft a lot of the communications and the marketing details and the performance from the operator themselves. So a lot of that work is handled for us. Obviously, we recycle it and reintroduce it in a way that is digestible for our investor base, which I think is pretty unique, and user friendly. But you know, we can rely and outsource so many things these days, which are labor intensive in nature, whereby we can just focus on raising capital. And that's really what our goal is each and every day, every week, is introducing our platform, which has, I think, had some pretty good success in a short amount of time. And the access we have is our moat, right? I mean, in order to survive in the next 5 years with the takeover of AI and technology, you need a moat or you're becoming obsolete. And our
Yeah.
moat is the access to the deal flow that we have.
So Ryan, the deal, do you anticipate that there's more deal flow than you can fulfill? And if you had unlimited amounts of capital, could you fill the pipeline? Let's say if you had $100 million. And the second part of that is, at what point are you not interested because you'll get uh, negotiated out of the market because institutional money will come in? Is it a $300 million asset? Is it four? Is it fair to even ask that?
It's a fair question. However, I've thought about it. As I mentioned earlier, we don't want to compete with the institution. And I know that the space that we're actively playing in now is not of interest to the institution. They, first of all, economically speaking, they can get away with yielding far less than I want to. So
Yeah.
they're entering the core plus markets. They're buying the 3-4 caps because they have more patient capital, A. B, they can get away with a 3-4% return. I'm not doing this for a 3-4% return. My investors are not investing me with that.
Right. And isn't it also true they can get away from that because they have investors or balance sheets that don't pay taxes, foundations, et cetera, et cetera, et cetera, right?
That Sure, that everybody has their reasons, but I think, to your allocation question, my goal is to get to a point where, within the current deal profile that we invest with, and without getting too crazy on the bench of GP operators that we deploy into, we can comfortably deploy 50 or 100 million a year and not be 100% of the equity that is required to close these deals. I think last year I did some math the other day because I had this question asked by an investor. I think the total equity raised within the deals we invested last year was about 140 million, something in that range. And mind you, that's across 10 assets, with an average purchase price of, say, 20 to 40 million. Okay. And so we're a small part of that now, right? But the goal is to still play in our space, however, scale up to the point that is irreplaceable from a GP operator standpoint to have us in the deal. And when you get to that threshold, our economics become extremely outsized, and everybody on our platform benefits. So I don't want to get too big. There's no reason to, right? I think, and also to that point, we benefit by cycling equity quick. And so, even if, you have 100 million of commitments for the year, ideally, the original funds and the original deals you invest with are liquidating on the other end.
Right.
So you're constantly cycling through your capital sources in a point where the returns, ideally compound and people reinvest. We have a 25% reinvestment rate from prior fund investors into more recent ones, which is fantastic. It means we're doing something right. But I don't want to compete with the institution. There's no need. Our economics, our leverage, what we command, our relationships, we want to play in our mid-market space, and there's no reason to jump outside that.
So on the cash on cash 8% that you're giving your investors, is that essentially pass through from the GPs?
Yeah. So it's a good question. So as at the fund level, we offer an 8% pref to the investors. That 8% pref is not 100% satisfied at the deal level. So it takes a liquidity event to catch up and then to hit the waterfall, right? So I would say on average, we have a two-pronged barbell approach, I call it. We have a value add approach on one side, which obviously are assets that are a bit more distressed, mismanaged, neglected. We're coming in, it's a heavier lift type reposition play. There's no yield on that day one. There's probably no yield or cash flow on that month 6. Generally, the idea is to target stabilization between month 12 and say 14. At that point, you're yielding 6 to 8%. On the other side of the barbell, you have our core plus strategy, right? 3 out of our last 4 deals that we acquired are producing 7 to 9% annualized cash flow day one. So our investors benefit first quarter post closing, they're getting distributions. However, 40 or 50% of their deployment, their commitment, might be in that value add bucket, in which case it takes 12 months or so for those assets to catch up to that number, right? However, generally speaking, on a value add deal, you put some type of short-term debt instrument in place with no prepay where you can refinance once the asset stabilizes, and you can return
Right.
30, 50 plus % of everybody's commitment in that deal, and then it starts to cash flow. So we have the beauty of investing in different types of buckets where our investors don't have to wait or get locked out 5 years and wait for a portfolio roll up on the exit to see anything. We offer cash flow. We offer liquidity events mid-fund term, which is 5 years. I have a 1-year extension option. However, you also get, the benefit of liquidity events and
Along the
staggered
way. Yeah.
along the way and staggered, opportunistic exits, right? Each deal is going to sell when it's ready. So within your 5 property portfolio per fund, we're investing in different markets with different operators, all of whom have a 3 to 5 year rough hold period. These deals are going to sell in year 3, in year 4, in year 5. And so you're not waiting for a roll up at the exit to get your liquidity event. We're popping these things once they're ready. If we get an off market bid, if we get, if we stabilize and decide to list it, hopefully rates settle in at that point. I think we can all agree it's probably going to be a bit better than it is today. However, I do think we're in a new norm, a new band on rates. I think it offers a little bit of protection and downside risk hedge against that for everybody and every type of investor, from the LP, to the institution. It's got a little bit for everybody. And that's the goal. That's the goal is to create consistency. Beyond the cash flow, there's massive tax advantages by investing in multifamily real estate.
Yeah, I was going to
right?
ask you
So
what
every
does
deal.
all the
Yeah.
goodies pass through, the K1s, the cost seg, the depreciation, all that business?
I like that. All the goodies. Yes, all the goodies do pass through.
Yeah.
And that's a major benefit to being a real estate investor, right? Passively. I mean, we have all the depreciation from the cost seg analysis, and if that's not performed in year 1, it's 2 or 3. That flows directly on everybody's K1s down to the investor level. They can offset, ancillary income, W-2 revenue. Our distributions and recaps, refis, when we're returning principal, tax-free, right? You don't pay capital gains on those. That's not a
On the
trade.
refunds,
That's
yeah.
not a taxable event. Yep. And
Yeah.
so, it becomes a system where, you can expect quarterly distributions cash flow. You can expect a little bit of a gift, a goodie, flow through down to your K1 on an annualized basis. And then the exit optionality, I think, is a major feature of what we offer, is something that, is predictable and expected between years 3 and 5.
And if the GP does a like kind exchange, you just benefit from that as well, right? If you decide to participate in
Yeah.
the new asset.
Yeah. I don't love that idea. I've been
Really hard to
in
do,
several
right?
1030. It's hard to do because you gotta, there's carried provisions, there's tick exchanges, there's, obviously you have to go through a QI, a qualified intermediary. You got to solve for equity, you got to solve for debt. And I can't predict whether my investors want to participate in that, right? So I guess that's a
Right.
wedge that I have not experienced yet. Although chances are, we're now in 12 assets or 12 properties, some are portfolios. It's going to happen. And I'm going to have a conversation with the investors within that fund that's invested in that deal. Hey, what do you want to do? Chances
Yeah.
are nobody's going to have a problem with it, because if we've done the right thing and the operators performed and everybody's been
You made
successful and
money.
multiplied their
Yeah.
capital, why not do it again?
Yeah.
Right?
Yeah.
Uh, exactly. And so that is a feature that we haven't toyed with or had to yet, just because we've only, been around for a couple years at this point. So, but every day is a learning curve. Things pop up, you got to solve for them. But we have a lot of, good investors in our network. I'll give you an example. There was an investor in our second vehicle, our second fund. We were probably 60% drawn down on their commitment. I got a call from this individual, and they basically told me that life happens. I can't. I'm
Yeah.
maxed out. And when you have a closed fund, obviously you got to solve for that. However, I reached out to that fund investment group. There's probably about 30 or so individuals in that group. And I say, look, I shared the story. Within a matter of hours, that allocation was absorbed,
Was sucked up. Yeah.
was sucked
Yeah.
up.
Nice.
And so that's the power of the network that we're building. With interested parties, people that believe in what we're doing, want more, feel like they didn't invest enough, when they first committed. But that's also why we're reintroducing new vehicles. I've had that question asked a lot too. Why are you putting out so many funds? Well, I talk to people every day. And, if I put a fund out, we're trying to wrap one up in the next 30 days. If I have 50 conversations with individuals or family offices that have interest in the next 3 months, and I have the deal flow and the allocation in that deal flow, let's go. Let's put another one out
Yeah.
in the market, right? Capitalize on that momentum. And so that's
Yeah.
kind of the thesis that we've adopted in a short period of time that makes this strategy very predictable, repeatable, and deployable.
Is it qualified investors only?
Everyone's accredited. We generally run 506B and C type offerings.
Yeah.
I'd say our minimum's $100,000. We have a few inside that. We have several entities that have come in that are 3 or 4 or 5 different individuals, say family or friends, that have put 300 or 400,000 in. I would say our largest investors, are around $1 million, which includes myself. And, we are actively in discussions with a couple families, a couple RIAs, folks that are going to provide some scale in 2 different forms, either in the fund, commingled with other LPs. However, we've also launched a separate JV co-GP strategy for larger single source capital check writers that want to commit 5 to say 20 million of their own, deploy it in the same fashion, but might have their own profile of deal. And so, for instance, family office XYZ wants to commit 5 or 10 million bucks, but they only want to be on 200 unit assets in the Southeast. We're confident that our bench and network of operators can supply that deal flow to that source. And so that becomes a bespoke strategy that's a bit of a different silo, introducing the same deal flow, but to a different type of capital. And so
Yeah, that totally makes
clearly
sense.
that's a network that we're trying to crack into right now.
Yeah. So you mentioned one more thing before we wrap it up, if it's okay. And we can talk about whatever else you want to talk about. But I was interested to know a little bit more about how you feel we've maybe reached a new level in interest rates and what your thinking is around that.
Yeah, I try to ignore it. I mean, we've been in a band of, I'm calling it the new norm, as I mentioned. You can't run a business, particularly with the activity that we try to have, and really get too hung up on that. A way around is to assume a loan, which we did about 5 deals last year. We assumed interest rates that were originated 4 or 5 years ago that have a good term left to maturity, say 5 years, 2.9 to say 3.25%. And so, yeah, it's lower leverage. Yeah,
Awesome.
you have to raise a bit more equity to acquire these
Yeah.
deals, but positive leverage day one. These properties are yielding significantly out the gate. There's some value add ramp up as well. However, on the flip side, in our business, FHFA is very incentivized to put capital out the door, right? From a debt standpoint. And so there's a lot of levers, and I know this because I was in the business for 15 years, something called mission critical business where there's an affordability aspect. So for instance, there are calculations that peg your current rental rates to median incomes in various markets across the country. And if you qualify as a certain ratio, you get a certain spread reduction on your interest rate. And so the agencies, Fannie and Freddie and HUD, which are the largest capital debt provider of liquidity in our business, incentivize operators to go after assets that are considered affordable rich. And so that is a way today to acquire a deal with a 5-year fixed rate loan inside 5%. You have a 4 handle, 4.849 in most cases, with non-recourse, with interest only, maybe some exit flexibility on the prepay as well. So we know what levers to pull in the interest rate environment game to make sure that our investments are safe and sound. I would say going forward, look, listen, I don't think we're going to see a lot of rate cuts this year. And the reason being is because our GDP is on a hockey stick trajectory. We do have a new chair coming in. It's going to probably take 3 to 6 months for him to implement any type of policy change. And, there's a lot of macroeconomic and geopolitical events taking place that implement and inject volatility into treasury markets. And so the only hook that you have is to either reduce the Fed funds rate, say a quarter point, 50 basis points, purchase bonds, which Trump has touted he wants to do. However, what people don't realize is that multifamily and commercial real estate investing in general is pegged off long-dated treasuries. Long-dated treasuries have a predictability to them whereby they forecast market conditions 6 to 9 months in advance. And so if the market is projecting a rate cut of, say, 50 basis points, in Q2 or 3 of this year, it's already baked into the 10-year treasury. And so it's pushed out, right? And so regardless of what the Fed decides to do, it's such a nominal move. It doesn't move the needle in our business. And so you can't really, when you're investing and you're consistent and you have the action and activity that we do, you don't really look towards that. You look 3 to 5 years out and you try to normalize your predictions and your assumptions in a way that, okay, great. If the market stays where it is, here's our result. I'm okay with that. If the market cooperates or maybe rates come in and there's a little cap rate compression, even better.
Yeah, bravo.
But,
Yeah.
I think it's a new norm. I think, we're not going to see a 10-year treasury, inside 4% for the foreseeable future. It's just, it's not supportable. And quite frankly, you don't really need to do it outside of, trying to force people to buy homes. Businesses are performing, right? And they're changing guard and technology is advancing. And, unfortunately, there's going to be a lot
Economy's
of
good.
obsoleteness, if that's a term.
Yeah.
It's good. And people hate to admit it. They hate it simply because of the man up top. And it's not about politics. But, unfortunately, the gap of the haves and the have-nots is widening, which is going to be a forever issue. But I think for us and for our marketplace right now, predicting rates in 12, 24, 36 months is a useless endeavor. And I think we're in a new norm. I think things are getting reset. I think valuations are getting reset. And for us, the good thing is, yes, rents have come down or plateaued in many instances, but that's a supply issue, not a demand issue. Demand will continue to be there. It will accelerate. I think we are 7 million units short across from a housing standpoint on the supply side across the country. You can't build those
That's what
units
they're
in a
saying.
quick enough time. Yeah,
It's not going to
for
happen.
occupancy
Yeah.
rates not to maintain a north of 90% level. And so that's my prediction. Could be wrong, could be right, but we don't run a business in our platform based on predictions. We try to stay within the goalposts of what we have, and make sure that the people we're investing with are the right guys to steward our capital.
Yeah. Totally makes sense. This has been super helpful. I really appreciate you doing this. And thanks for, I mean, there's lots of good nuggets in there. I know people appreciate it. And we also look forward to you, as you know, coming on and telling the story to the investor community for FOI too. So, Ryan, thanks for doing this. Really appreciate it.
Thank you.
Nicely
I
done.
appreciate it. Yeah, no, likewise. It's a great opportunity. As I said, it's a huge gap in what I'm trying to fill right now, is the capital sourcing from these mid markets and upper middle market type family offices, and so we're putting resources towards it. I'm trying to educate folks on what we're doing, how we're doing it, and why we're different, which I think is something that is hugely important in today's environment with a lot of noise.
There's a lot of noise, and you are different. There's no question about that. I can confirm it. So, and we look forward to having you in a couple weeks to talk to the rest of the group. So, all right, Brian,
Awesome.
thank you.
I love
Really
it.
appreciate it. Thank you,
Thank you.
everybody.
Appreciate it.
Thank you,
Take
everybody,
care.
for joining us
All right.
today. We'll talk to you soon. Bye bye.